Hi, this is Bruce Berger. Today we're going to be discussing Dawson Geophysical. However, before we do it, let's go through our disclaimer. Turnaround Stock Investing is not an investment advisor. This content is for educational purposes. Please see the disclaimer at Turnaround Stock Investing. Here's a brief summary of what we're going to be discussing in the video today. We're going to go over Dawson, which is the leading provider of North American seismic data services. And the reason I'm presenting it is because Dawson is now trading at a very cheap price compared to what it can earn in the next cycle. We have a rock-solid balance sheet which allows it to survive the oil service depression. It has a leading market share in providing its seismic services. And I believe the stock is a possible four-bagger, meaning it could potentially rise 400%. This video is going to go over the supply and demand for seismic services. We're going to review Dawson's stock chart to show why I believe it's bottoming. We're going to go through the detailed Dawson's financial statements, and I'll review how I came up with the potential EBITDA for the company. So this video will probably take about 10 minutes, but you're going to learn a substantial amount. You're now looking at Dawson Geophysical's 10K report, which is filed with the SEC. And we're going to go through this report so I can take you through a description of the business. As mentioned previously, Dawson Geophysical is a leading provider of North American onshore seismic data services. They generate revenue by operating what are known as seismic crews. As of December 31st, they were operating 7 seismic crews. As of December 31st, 2016, the company owned 22 land-based crews. This is an important number to understand as we get into building the income statement later. So they have the capacity for 22 crews. You're now looking at a picture of what's known as a vibrator truck. I'm showing this to you and we'll be showing you a brief video so you can get an illustration of the services that Dawson performs. We're now going to be watching this brief video to show how the vibrator truck vibrates the earth. Through this vibration, the truck sends energy, acoustic energy, into the ground. This energy is then received and processed and interpreted to produce images of the Earth's subsurface, and this is used to help locate oil and gas reserves. In addition to vibration equipment, Dawson also places hundreds of geophones around the vibration site. This is why a typical seismic crew operates with approximately 40 people. Now that we have an idea visually of what Dawson is providing as a service, let's talk briefly about the competition. It's difficult to estimate exact market share that Dawson has, but I estimate that there's probably 12 or 14 seismic crews operating in the United States right now, and Dawson probably is operating at any one time right now, maybe 6 or 8. So their market share is indeed quite large. They are the preferred provider of seismic services to the major oil and gas companies in North America. We're now going from the financial statements and a review of Dawson services to a picture of the stock chart. This is a 10-year chart, and as you can see, Dawson has had quite a boom and bust, just like the oil service cycle in the United States. Before the oil and gas boom of the last few years, the stock had risen from basically $4 a share up to 30, and during the oil crash, back down to 4. The operating leverage in this business is enormous, and this is the reason that the stock price has so much volatility. I want to point out here how stocks that often go through booms and busts frequently go back to old lows. So you can see here in 2009 where the stock was 3 or 4, and look at what happened. It has come right back to these levels, tested it here with the crash. This is when oil was about $25 a barrel. We had the run up when oil went into the 50s, and with the major concern about oil prices, the stock has come back down. Now this is a weekly 10-year chart. Let's take a look at a shorter term chart. You're now looking at a 1-year chart, and I'm using this to illustrate the point that in 2016 when we bottomed, when oil prices were around here, you could see where the price reached around $3. This I would describe as the height of maximum pessimism. The world was going through the commodity crash. Stocks were being pummeled. We went to the lows of about $3. We then had the subsequent rise, and you can see where the stock went to about $9. And then with the concern of oil prices resuming their decline, we went back to $4. This is an excellent bottom that's coming in here because the pessimism that we've seen in oil service stocks has been extreme, yet the stock is holding. And more importantly, it's holding above its old lows. This to me suggests that we are witnessing another very important bottom in this stock. Let's now return to the company's financial statements. This is the June 30th, 2017 10Q statement. And on this balance sheet, we can take a look and see a very solid balance sheet. We have here cash and cash equivalents of about $44 million currently, which is equal to $2 a share. The stock price is currently trading between $4.20. The book value is $671. There is de minimis debt. There's only $1.6 million in debt. Now, many people in the oil service business dismiss the book values currently because they're on the books at prices that are way above what you could get in the current market. However, in the seismic business, I consider the book value pretty solid. The key to Dawson's ability to retain customers like Schlumberger and Exxon is because its equipment is state-of-the-art. As we'll be going through later and looking at EBITDA compared to CapEx, the company has spent an enormous amount of money on its seismic infrastructure. So while if it wanted to liquidate currently, it would not receive this book value will produce the cash flows that will come in the next cycle, and they'll be pretty enormous. So I consider that we're buying this company at a significant discount to replacement value. But also, this book will go on and generate very good cash flows. Now we're looking at the income statement. And the income statement is not as beautiful as the balance sheet, because as you can see here, in just the last quarter, loss from operations was $15 million. Now, you have to back out the depreciation and amortization of $10 million. So basically, this company lost close to $5 million in cash last quarter. Now, that's an enormous amount of money because annualized, that's $20 million. But let's think about why this occurred. You're now looking at a reconciliation in the 10Q to their EBITDA. And as you can see, they started out with last quarter with a $14.8 million loss, which generated a negative $5 million in negative EBITDA. Now, if you compare that to the quarter last year, it was $1.4 million. The reason that this occurred is because the contracts that Dawson takes on to provide geophysical services are turnkey contracts. So if Dawson is performing service and it's raining or horrible weather for 1 month, they have got all of the infrastructure, crews, equipment on site, but can't perform the services. So they're going to be losing money during that time period. And that is why the company lost this amount of capital. Now, what's going to happen in the subsequent months is this EBITDA, this loss will reverse. And as they provide those services, the company will generate the cash that it lost during that downtime. My opinion and what I've thought is that this company per quarter will probably lose before CapEx, if cycle stays where it is, $1 million a quarter, where it was in the previous year. The company is very good at downsizing its costs and running efficiently. But of course, you want to stay in business for the cycle to come up, so they're running overhead that is generating a small loss. So while this loss this quarter was large, I don't think it is a normal operating loss. And in fact, in the last earnings call, the company expects things to improve significantly. Now that we've gone over the quarterly numbers and come up with a logical assumption that they may burn, if things stay the way they are, $4 million, $5 million a year. Compare that with the $44 million in cash, there's tremendous staying power. So now let's discuss how I came up with my concept that the stock was trading at a future multiple of 1 towards next cycle EBITDA. And right now you're looking at a spreadsheet that I created. It's my pro forma model of how I came up with this number. We'll look at this and then we'll go back and look at historical numbers to prove it out. So right here, I'm estimating that in the next peak cycle, Dawson will be running 14 crews a year. Is that an unreasonable number? Right now, in the depths of a depression, they're running 6 to 8, maybe up to 9. So to take that back to 14, if oil will return to $70 or $80, is not a far-fetched notion. In fact, remember, as we pointed out in the beginning of this talk, they have the capacity for 22 crew units. So I'm still at a significant level below potential capacity of 22. I came up here next with an annual revenue per crew of $24 million or $6 million a quarter. Now let's examine how I got to that. You're now looking at a spreadsheet that I've done for the various quarters over the last 3 years: March, June, September, December. And on the bottom here, you can see I've calculated out what the revenue per crew is for the quarter. So in this case, the company was operating between 8 and 3 crews. I'm estimating 5 for the quarter. That was $7.6 million revenue per crew per quarter. Here it was $9 million, which is sort of an outlier. Then we go to 4, and then in the quarters of June, we have 5, 5.6 million, 6.2. And then in September 16, we've got 6.2 million, 6.2 million. And December, we've got 6 million, 6 million. If we then go back and look at the year ends, we've got it right here. In 2014, 2013, the annual revenue per crew was 26 million, 23 million, quarterly 6.5, 5.8. Now, these previous years are not available because the company consolidated with another business, and I was not able to get the crew counts exactly to match those revenues. But I think it's normal to assume that a $6.2 million per quarter crew revenue is not an absurd assumption. Going back to the pro forma model, 14 crews, $24,800,000 a year per crew is $347 million. I've got here a gross margin of 19%. I'll go in and I'll explain that again later. We then attach a $22 million SG&A, and we come up with $43,968,000 in EBITDA. As I mentioned before, we are paying $44 million for this business right now. How do I come up with that? Well, there's 4 stocks at $4 a share. There's 22 million shares outstanding, which is an $88 million market cap. There's basically no debt. So our enterprise value is $88 million. But we've got $44 million in cash on the balance sheet. Brings us with a net enterprise value of $44 million. That is the 1 times EBITDA. So let's now go on and see, where can this stock trade in the next cycle? If we make the assumption that it's possible oil prices can go back to $60, $70 a barrel, there's no doubt that oil service stocks will rise dramatically. To assign an 8 multiple to our $2 a share in EBITDA, I don't think is unreasonable. So an 8 multiple, $2 in EBITDA per share, is a potential price of $16. So that's where I came up with our ability to have a multi-bagger here. There's a lot more that can be discussed about Dawson, but I think we're at 13 minutes now, and I hope that you've gotten a lot out of this and recognize the opportunities purchasing Dawson Geophysical stock at its current levels.